Very quickly, who am I? Yes, I'm head of precious metal sales at ICBC Standard Bank. I've been with the bank about 3 years. Before that, I was at Credit Suisse for about 5 years. Mitsubishi before that in a trading house. Before that, I worked for Johnson Matthey, one of the largest precious metals refiners. So a checkered history, some might say. But ICBC Standard Bank, for those of you who aren't familiar with what ICBC Standard Bank is, Standard Bank had a global markets group that's been active in the trading, the financing of commodities for something like 30 years. In 2015, ICBC, Industrial and Commercial Bank of China, China's biggest bank, at about $4 trillion of assets, purchased a 60% share in that business. So we're a UK independent PLC, but our 60% shareholder is China's largest bank, and Standard Bank of South Africa is still our 40% shareholder. So our focus is very much what it has been for the last 25, 30 years, physical commodities, financing, trading, in particular in frontier markets, so Africa, Stans, parts of Southeast Asia, and bits and pieces in Latin America. Gold and silver, I'm supposed to be talking to you about this morning. Silver being an industrial metal in quotes. I'm actually going to focus quite a lot on some of the macroeconomic background. I'll try and keep it simple, mainly because I'm a geologist by background, so economics doesn't sit terribly well. As an entity, we ship and move a lot of physical materials, so I'll try and be quick and leave some time for Q&A. We have about a 25% market share of the Indian gold market, for example. We ship and finance about 30% of all the silver concentrates that go into China and get smelted and refined in China. Obviously, our biggest shareholder is got a huge physical gold business onshore China. And we deal a lot with the people at the front end of this business. We finance and trade with jewelers, refiners in places like the Middle East, Africa and elsewhere. And we have one of the largest vaults. We operate, it's here in London, and so we operate and act for everyone you would expect to hold physical precious metals, be they sovereign institutions, institutional investors, and ETFs. Right, so what am I going to talk about? Supply and demand, I called this presentation, which for me, when you talk about gold, people love to look at the detail of gold and silver in a classic commodities research analyst perspective. They build their models of mine supply, they look at cost curves, they look at the demand side, they look at jewelry, they look at industry. They usually end up with some kind of guesstimate of investor demand and a residual line at the bottom, which is essentially a very wide margin of error. And all of that is relevant and important, but for me, working in this business for something like 20 years, the thing that overrides all of that a lot of the time is what's happening at the macro level. And you know, we can talk about gold and silver in different currencies and what that means for buyers and what it means for producers. But the thing that always captures the attention is what gold and silver are doing in US dollars. So we need to think about what is happening to the US dollar. And we need to think about supply and demand for what I've termed here US government promises, i.e. supply and demand for treasuries, for US paper. And what tells us what's happening with supply and demand is the interest rate, of course. And so the chart there on the left-hand side is the two-year Treasury yield. So everybody, I'm sure, is aware that interest rates have been going up. The Fed has been tightening and been tightening more rapidly over the last 6 to 9 months. And we have to ask ourselves, what is that telling us about the supply and demand for US paper? What is it telling us about investors' attitudes today and tomorrow? And why are those yields going up, and what does it mean for gold and silver? So the Fed is obviously putting up rates at the front end because growth is accelerating. There's been obviously this very large fiscal stimulus from the Trump administration. There's labor tightness in the US that we haven't seen for probably more than a decade. So the Fed is looking at all of that, is looking at 1 to 2 year forward inflation expectations, and is trying to stop the economy overheating. But interestingly, most of the effect has been at the front end of the yield curve. And you can Google yield curve and see all kinds of headline-grabbing stories about what a flattening yield curve means and why it's preceding an imminent recession or why it's not. Essentially what it means is that interest rates are going up in the kind of the 1 to 2 year space. But if you look at 10 to 30 year longer dated yields, there's very little happening. This one shows the 10-year Treasury yield, and this is the 2-year. And you can see the gap is narrowed. That's the flattening yield curve. Longer-term rates, they have picked up a bit, but they're not really moving that much. They're still in the range that they have been for quite some time. So we need to think about what message that is giving us. The Fed and investors are thinking about quickening economic growth and quickening inflation in the near term, but there doesn't really seem to be any concern longer term. So you could characterize this as a sense of some sort of disbelief that things are going to continue to move in a Goldilocks direction for the US economy once you get past that sort of 1 to 2 year horizon. The other thing, of course, that's happening, which is why yields are going up, is if you make large tax cuts and your tax take goes down, and you've got a lag until the economic growth picks up to balance that out, then you're left with a funding gap. And that funding gap has seen a significant increase in supply of treasuries to the market. That's the supply side of the supply-demand curve for treasuries. The Fed has issued a lot more short-dated paper over the last 6 months. So if you've got an oversupply of something, you need to get that supply absorbed into the market. And the way you do that with bonds and treasuries is by increasing the yield. And that's what you've seen contributing to this. So the Fed has been printing a lot more paper. There's also an element of concern within the interest rate message. There's concern longer term, but what it means is for gold right now is that the real interest rate is pushing higher because the Fed is moving faster than inflation. Yes, we can see unemployment has reached almost historic lows in the US. Importantly, the proportion of people who are working part-time has diminished sharply. The number of respondents to the Bureau of Labor surveys who say that they would want to work longer hours but can't has diminished sharply. And so you've got inflation concern ahead picking up, but inflation today not really moving. So the real interest rate has picked up, and you're in positive territory now, which you haven't been really since before the financial crisis. This, of course, is the period of massive quantitative easing. This was where everybody thought the financial system was about to end. The collapse of various financial institutions, as we know about, and gold peaking at around $1,900 an ounce there. And then this is a result primarily of the beginnings of talk about monetary policy tightening. So you had the taper tantrum famously about there. And the point being, in this kind of environment, deep financial stress in global markets, negative real interest rates, extraordinarily positive environment for gold and for silver. And in this kind of environment, silver tends to outperform. Since then, we've had various attempts at normalization, and it's taken, what have we got here, 7 years, 8 years almost, to have a period where growth globally is in sync, more or less. It's still fairly weak in some places, but growth in Europe is not too bad. Growth in the US is very strong. Even in Japan, we're seeing some decent growth numbers. But that's the short term. This is what's important for when we look 4, 5, 6, 7 years forward. So the US, as we know, with the world's reserve currency, operates a deficit. This is the deficit as a percentage of US GDP. This again here is the period where we saw gold and silver performing tremendously well, where you saw the US deficit really accelerating relative to the growth generated by the US economy. And here right down in this heart of the stress is where Standard & Poor's downgraded the outlook for the US. And that, again, coincided with the real strength in gold. This coincided with a real run in silver up almost towards $50 when silver was outperforming. So the question really is where do we go from here? You've got two components here. One is growth, the GDP. Do you believe that the policies enacted by the current administration and still relatively easy money can see US growth outperform expectations and close this gap? Or do you think, well, actually, given the way the US economy and the demographics look, we're going to start rolling over and we're going to be heading back down this way? On that point, let's think about who owns all of this US government paper. So this is the QE. So this is the Fed buying the Treasury issuance here to stimulate the economy and slowly letting that debt roll off. They're not selling any of it, but they're not reinvesting the proceeds of what is maturing. It's going to take a very, very long time for that to come down, but the point is it's not going up. The Fed is no longer a buyer of treasuries. Who are the other big sovereign holders? It's China and it's Japan. China more or less stable at a maybe $1.25 trillion worth of US paper. Some very big headlines when the Chinese started to sell down some of their treasury holdings about a year ago. And the Japanese, the second largest holder, on a slow kind of trend downwards. So the question is, if these three big holders of US treasuries aren't buying and maybe are actively letting their portfolios dwindle, then where is the next buyer coming from and who is it? And what kind of interest rate are you going to have to pay people to buy US debt going forward? If you can't fund your deficit entirely through debt, of course, you need those fiscal balances, those tax receipts to fund your domestic economy. But the problem here is one of demographics. So this chart is showing you the ratio of 65-year-old and plus in the US economy to the working age population. And so you can see here we're on the start of quite a significant trend. This is demographic trends. Once they start, you can't stop them. Ask the Chinese about what the one-child policy did to their demographics. So this is the end of the baby boom bonanza, if you like, for the US economy. The number of elderlies going up, the number of people contributing to economic growth and the working age population is starting to fall. And basically what that means is there are more takers from the economy than givers to it in terms of generating tax receipts. And finally, on the supply-demand thinking for the US, supply and demand for the US currency. So we all know that gold inversely correlated to the US dollar, as to a greater or lesser extent are all commodities priced in dollars. This is just showing you the 30-day rolling correlation, gold versus a dollar index. I've used here the trade-weighted dollar index. You can use whatever dollar indices you like, DXY. You'll see a similar pattern. And you can see the correlation is always, with one or two exceptions, strongly negative. So stronger dollar tends to equal weaker gold price. That's nothing new. But what's interesting is, again, if you start to look longer term, who are the big holders of US dollars? It is other nations, it's other sovereigns, it's reserve managers in central banks. The blue line here is that trade-weighted dollar index. The golden line is those other reserve managers, their share of US dollars in their overall FX reserve holdings. And you can see back before we really entered that run into the financial crisis, US dollar typically made up 70 to 73% of any other central bank's foreign assets. They were already declining going into the financial crisis. Those central banks were aware that they were overweight dollars. They wanted to get that down. There was a spike here as we reflated, but since then, the dollar has become less popular again for other central banks. And that is very meaningful going forwards. And then you have the supply and demand for what I've called insurance. And gold has to compete here for everybody's dollar. It's a non-yielding asset. It has to compete against equities. It has to compete against bonds. It has to compete for other forms of insurance when you enter stressed conditions. But what's interesting here, I'm showing you real interest rates again. That's the blue line. And you can see that there are periods where gold and US real interest rates do diverge heavily. So this is the period 2002 going into the financial crisis. US interest rates here, real interest rates, it's an inverted curve. So this is rates going negative. This is rates rising, coming down the chart. So here we had rates going negative, which should have been very bullish for gold. It was, but there were other factors happening there that meant there was a significant lag and suppressed that bullish reaction. There was the de-hedging by major mining companies. There was still selling from the central bank community, for example. Here, today, we've seen, as we've shown on those other charts, interest rates are getting more and more positive, and yet gold is actually holding rather well. It's trading around 1,300. From this kind of rough correlation, you'd expect it more to be like 1,100. So there's something going on there that gold is telling you is forward-looking. It's showing you that there is that concern about once we get past this boost to the US economy that's come from this very, very sizable tax reduction, what next and what happens to the US and how it funds itself? And I think the answer is again, for me in the short term, there's no doubt the US economy is doing extremely well. There's no doubt that capital is going back into the US. That helps with a stronger dollar. There's no doubt that the interest rate differential between the US as the Fed puts up rate and the ECB stays on hold is attracting inflows into the dollar. So short term, I do think this presents quite a headwind to gold, particularly when the traditional physical markets in India and China are fairly quiet. And I think the further forward we go, the greater probability is that you start to see some of the stresses come to the fore from that imbalance that the US has in terms of what its fiscal projections look like versus what its spending needs look like. And so on a 5-year horizon, I think it's quite positive. Does silver outperform gold? You look at the ratio, it's very hard to predict. You look at supply and demand from an industrial perspective, you can create all kinds of fantastic good stories about silver. But for me, it really is about the global macro and the financial stresses. In that vault that we have here in London, you know, it's a very modern facility. It's constructed with multiple layers of physical security, multiple layers of monitoring, surveillance. We have an outer perimeter fence that can withstand a truck traveling at 60 miles an hour. There's a hardened outer building shell, et cetera, et cetera. As you go in, one of those onion ring layers of defense is actually all of the silver we hold in the vault. There's so much silver in the vault that we and others place that silver to make it incredibly difficult for anyone, even had they got through all of that outer layers of security, to actually get physically towards the gold. So you can think about silver in a supply-demand balance, who's soaking up the surplus or the deficit, if you like. But you have to remember that there is no shortage of silver in the world. There hasn't been a shortage of silver in the 15 years before the financial crisis, through the financial crisis. There have been occasions where there's been an availability issue for certain bars of silver, deliverable qualities of silver, getting it to the market in a short space of time, but there's definitely no shortage of silver. I've run out of time. I am just going to put up one chart which is relevant to what the panel were discussing earlier, I think, which is a good old-fashioned mining cycle chart, and where are we on that cycle? Some of the many books that came out of the financial crisis talked about whether this time was different, and Manias, Panics and Crashes. It was one of those famous books that's well worth reading. In the natural resources industry, it's never different. It's always a cycle. It goes up and it comes down again. But to the point that was discussed earlier, I think, is what will be different is not the fact that we're in a cycle, and I think we're in a very, very good part in the cycle right now, but the duration, I think, will be different. Typically here, we can talk about 5 to 7 years from peak to trough. I think because we've come out of such an extraordinary period of financial easing, and because that was such a long period, then I do agree that this period from peak to trough is going to be unusually extended. So rather than 5 to 7 years, I think we've probably got at least another 10 years before we hit the rollover where shareholders start to demand the wrong things at the wrong time. I'll leave it there. Thanks very much.
Thank you, Tom.